JSW Steel announced its result on January 25th. It was a mixed bag. The numbers look really great. Net profit has grown fivefolds, but the company has also cut down its Capex. Joining me today is Joint Managing Director and Chief Executive Officer of JSW Steel, Mr. Jayant Acharya. Welcome to Moneycontrol, Mr. Acharya.
Thank you very much, Rachita. Happy to be here.
Great to have you here. Mr. Acharya, the numbers by now I'm sure people have looked at and, kind of gone through the basic numbers. But help me understand how the third quarter of this financial year panned out for you. I mean, if we were to look at the bottom line alone, it has grown fivefolds from a year ago. But sequentially, there is a dip. Help us understand what really went behind these numbers.
Yeah. So we had a very strong production performance in quarter three. At 6.87 million tons, this was the highest production at JSW Steel, including our Ohio operations. It grew by about 8% quarter on quarter and 12% on YOY basis. Our sales at 6 million ton on a consolidated basis was slightly lower, 5% lower quarter on quarter, but still 7% higher on YOY basis. The primary reason for the drop in sales was lower exports because the global markets were weaker, so the export volumes were lower. That saw a drop of about 20%. And imports coming into India impacted the retail sentiment and resulted in some channel destocking, so the retail sales were lower. However, our sales to the institutional OEM industrial customers were at the ever highest in this quarter. Automotive sales, renewable sales, our tin packaging sales were at the highest ever. So we did a growth of almost 8% quarter on quarter in our OEM industrial and institutional sales overall. So our core focus is that, and that continues to remain strong. Automotive, as I said again, was the highest in this quarter. We see that going forward into the next quarter, it will be a seasonally stronger quarter. Internationally, the global steel prices have started moving up on the back of elevated raw material prices. And we would see some part of that getting reflected in the Indian market in the coming months.
Interesting overview of the environment right now. Mr. Acharya, help me understand. I mean, the India demand has been quite resilient, and not just JSW Steel, even Tata Steel has been riding on the growth that we are seeing in steel demand in the domestic market. Help me understand what kind of growth are you expecting for the final quarter of the year and for the next financial year? Also, in terms of, the year being an election year, do you expect some slowdown in infrastructure projects happening on account of the elections? Would that impact steel demand? What is your take on it?
Yeah. So in the quarter three, our imports into the country were quite high and our exports fell. So 16% was the growth in imports and exports also fell by an equal percentage of 16%. So we had a net import of 1.2 million, which ate into the domestic incremental demand quarter on quarter. But having said that, I think we now see a better traction in the January-March quarter with respect to the volumes, both from an international perspective as well as from a domestic perspective. Directionally, we do not see any change in the Capex spend or the focus on manufacturing which the government has undertaken. There may be a blip during the one quarter of the election, which may come in the next few months. But otherwise, directionally, we do not see any change in their focus on both these aspects. So we expect the India momentum, economic growth, as well as the steel consumption growth to remain strong in the medium term as we go into this decade.
You spoke about the net import rising a bit, and I remember when we spoke to you last after the second quarter, you had warned that there is a possibility of some of the steel being diverted to India because it is a strong growing market. Given this backdrop and the fact that the Ministry of Steel has said that they're not really looking at increasing the import duty on steel, is there a concern with steelmakers that things might get challenging going ahead? And is the industry talking to the government, engaging with them to see if there is a potential to kind of put in place a higher import duty?
So on a weak global environment, India is doing quite well, and it's today the bright spot among major economies in the world. Our steel consumptions in India reflect that, and we have seen very strong growth in this year for 9 months. Our consumption is at about 100 million ton level with a growth of almost close to 15%. But however, in the last quarter, some part of our demand was lost to imports. And this is typically a situation where trade is getting diverted into India because of a weak global market. And we need to be wary about that. As Indian steel industry is investing into Capex for meeting the demand of the country in the remaining years to come, we that the government will probably need to look at the imports coming in and take some measures, some trade measures to restrict unfair trade. As long as the trade is fair at pricing, which is fair, it's fine. But if it's unfair trade at predatory prices, we should be wary and take steps to control that.
Is this one of the reasons why you have reduced your capital expenditure plan for the financial year from 20,000 crores to 18,000 crores? Help us understand what's gone behind this decision.
No, that's only a timing issue. There is no change in the focus on Capex at all. If you were to look at the current year, just to put in perspective the demand, last year our steel demand in India was 120 million ton. This year we expect the steel demand to be in the range of 134 to 135 million tons, which means a 14 to 15 million ton incremental growth. If we look at even an 8 to 10% consumption growth year on year, every year we'll be incrementally adding this 12 to 15 million tons of demand in India. So therefore, the capacity in India is required to meet the domestic demand. And we are quite focused on that, and our capacity expansions is on track at Vijayanagar and BPSL both. We'll be completing our expansions of 6.5 million tons this year and another 1.5 million tons odd next year to reach about 37 million tons by FY25 end. So fully on track, and we remain focused on our capacity expansion program.
So the numbers that have been reduced, would it be right to assume that this will get passed on to the next financial year? And if yes, then what would the Capex for the next financial year look like?
So it would get passed on to the next financial year. It's just a timing issue. But from a Capex perspective, from a guidance perspective, we'll come back to you with more details for the next year during our next meeting with some more details on the volumes and our Capex plans for the coming year.
Is there more pressure on companies like you to kind of control the costs right now, given that the global demand continues to be somewhat weak and supplies remain strong and companies are adding capacity? How are you managing costs right now? And is there any solid plan in place to kind of secure raw material to cap the costs?
Yeah. So on the cost side, in this last quarter, we did see a cost increase because of higher coking coal prices and iron ore prices both. But we were able to balance that out with a better blend in terms of coking coal in our mix. And that's why we had an increase of about $21 on a QOQ basis. Going forward, there is a pressure on the cost in both coking coal and iron ore. Our efforts is to secure our position on both these raw materials. On iron ore, we are increasing our mining in Karnataka. Currently, we have about 9 mines, which is giving us 7 million tons. We would be adding another 4 million tons from our existing mines. Some of the environmental clearances have already come in, and the production should commence soon. We have been awarded 3 new mines in auction in Karnataka, which would also go on stream in the coming year in FY25. And that would take our production close to 15 to 15.5 million tons. And that would be a positive towards cost management at our southern operations. We are also ramping up our Odisha environmental clearance for additional capacities, and that would also go into our eastern assets in Jharsuguda, Raigad, and some part of that flows into Dolvi. So on iron ore side, we'll look at options which make strategic sense in terms of closer to our locations and continue to bid for that. On the coking coal side, while we are improving our blends and looking at using leaner mixes in our coking coal coke ovens, we continue to scout for assets internationally and domestically to improve our overall coking coal securitization. And these two remain our focus areas as we go into the next few years.
I think as a part of this strategy, you were also looking at a stake in Canada's tech, but very recently we saw that Glencore actually went ahead with the acquisition. What went wrong there, and what is the learning in that instance?
No, nothing really went wrong. I think from a perspective of participating in that divestment by tech, we were a strong contender. However, I think Glencore has taken a call to look at 77% of the asset, and Tech and Glencore have agreed to proceed on that basis. However, we remain engaged on our focus on acquiring coking coal mining assets in internationally and domestic. As I said, we are looking at Australia, Canada, and Mozambique for newer assets as well, and we are in talks with some. Our focus on domestic coking coal, as I mentioned last time, we have 2 mining assets which we have got now, which we are trying to commission as soon as possible. We will continue to look at more domestic coking coal assets to improve our blend and improve our raw material security on coking coal as well.
Is there something in the pipeline? I mean, can we expect any announcement of that sometime soon?
We are discussing with a few assets, but nothing concrete as of now, and we'll come back to you when we have something more clearer.
Mr. Acharya, there's also this buzz in the market that you are not really looking at sourcing any coking coal from Russia on concerns that that may probably make exports to Europe a little bit of a challenge. Help me understand what's your stance on that.
So we have a basket which is quite diverse in terms of our coking coal or metallurgical coal procurement across the world. And we have Australia, Canada, and various other locations from where we procure our coking coal, including some from Mozambique. We procure some from Russia as well for certain specific coals, which we have been doing for many years. That continues. We do not see any challenges with that mix which we are having in the blend. Also, we need to understand that metallurgical coal basically is intended to have certain properties used in the coking coal coke ovens, and therefore that blend is not immediately possible to replace. So whatever is continuing from Russia and other countries will continue in the same format. We are not trying to enhance further coking coal sourcing from Russia as of now.
How much does it account right now, Russia vis-a-vis the rest of the portfolio?
No, it's a small percentage. It's certain specific portfolios which is there in the corex and pulverized coal injection and metallurgical coals. It accounts for a small percentage.
All right. Mr. Acharya, of course, the group as such has been on a shopping spree for a while now, and the recent announcement on MG Motors is very interesting as well. Do you see any synergies there with respect to JSW Steel? Is there any plan of leveraging on that?
So our foray into the automotive space with focus on electric vehicles is being done by group companies, and that's a different business. JSW Steel will not be directly involved in that. As we progress into the joint venture and look at completing it closer to time, we will look at what synergies are there between the uh, MG Motors and JSW Steel. It could be specifically with respect to supplies of steel for their production of vehicles.
But as of now, you don't really have an arrangement in place for that.
I think this basically once the agreement gets fully crystallized and done, then only we will be able to discuss those arrangements.
Mr. Acharya, we are almost towards the fag end of the financial year. Should we expect any M&A related announcement from JSW Steel in particular in the rest of the financial year?
No, we don't see that happening. No, nothing on
Fair
the
enough.
cards.
Fair enough. Mr. Acharya, I know, this has been an interesting year and the upcoming budget would be an interim one. But I wanted to understand if you have any particular ask from the government for the steel industry.
No, I think our this is an interim budget, so our expectations are that the government would continue their focus on infrastructure spend and capex, public capex, which has stood us in good stead over the last 2 3 years. Our focus on manufacturing for encouraging self-reliance in India has been very good, and we look forward to government focusing on that as well. The transition to renewable energy has been a big focus again, and that is also going on quite well. I am quite confident that these spaces will continue to be a focus area for the government in the remaining years to come as well. From a budget perspective, the only area where we need to be cautious about is that the imports into the country are increasing since we are a growing country and the rest of the economies are not doing that well. We need to be conscious about that and be cautious that we do not allow unfair trade into India. And if such things happen, then we need to take appropriate steps to control that.
That's fair enough. We'll see if something comes out of the budget when the finance minister takes the stage on February 1st. My final question to you, Mr. Acharya, we are in January and a whole year ahead of us. What do you think would be the biggest opportunity for steel makers this year and the biggest challenge?
So biggest opportunity remains the growth in India, as we say that economic growth is our primary driver because a lot of steel consumptions comes from the economic movement in India. That's a big opportunity for us. So our capacity expansions are focused on meeting the domestic demand. On the challenge, I think we would need to be focused more in terms of looking at the imports and seeing that they do not become a drag with respect to our business. Other than that, I don't think there is any immediate challenge which we see.
That's good to hear. Pleasure as always talking to you, Mr. Acharya. Thank you very much for your time. Wish you all the best for this financial year and the calendar year as well. Wish you the best.
Thank you, Rachita, and wish you the same. All the best.
Thank you.